Good evening and good morning, distinguished guests from the World Bank, and also dear audience and viewers from China and around the world. This is Huiyao Wang. I'm chairing this actually webinar, special webinar event that we're featuring the Global Economic Outlook report that actually done by the World Bank. So it's actually a very critical timing actually at this turn of year when we enter the 2021. It's such an important occasion to look back, but also to look forward. So with the COVID-19 past the 90 million marks, and also with vaccine being taken in all countries, it's critical to really to find out what's next, how we are doing in the last year, and how we're going to do this year again with the new year just ushered in. So today we are very actually fortunate to have a very distinguished group that we had invited from the World Bank. So in this post pandemic area that we hope that we are getting into that state now, and to try to really keep the pandemic under control. The global economy is really crucial, and its recovery is really very important to keep us from the severe recession. So in this January, just last week, and the World Bank actually just published this global economic prospects. And the World Bank has made predictions for the world economics outlook for the 2021. So we see that the world economy actually went into a very deep retraction in 2020, and also different countries actually performed differently. And China also, today we are holding this in China. We see that China has probably kept some of its positive growth. But still, we need to see what's coming up next year. And so I think this morning we are really having a great event. I think World Bank is no stranger to China and to our friends around the world. And World Bank has been in China for many decades, and has really helping China on many projects, infrastructure projects, and many sustainable projects. I think that China was able to lift millions, almost 800 million people out of poverty in the last 4 decades. I think World Bank has also played a very positive role in that as well. And I still remember the days that I used to work with World Bank experts in China. And so I think it's really important that we have a World Bank, the most authoritative, I think, the institution on economic development. Particularly for the project development, to give us the forecast and also analysis. So so this is actually the second time we've done this. That on June 12, 2020, we had the very good fortune to invite Dr. Kose and Dr. Rainer to give a presentation on actually during the crisis of the pandemic, to give us the forecast. We had a very good response and reception from China. So today we would like to do it again, and Center for China and Globalization being the leading non-government think tank in China, we really want to be the bridge between China and outside world, and particularly this special time of the new year just beginning. We like to bring our top international experts from the World Bank to give us the new perspective and new introduction. So I want to actually introduce our guests today that actually participating our webinar. So we are actually very fortunate to have quite a few renowned experts to join us. So first of all, the experts actually joining us today is that Dr. Ayhan Kose. He's the acting vice president of the actual World Bank EFI practice group and director of EFI prospects and of the World Bank. Of course, EFI stands for Equitable Growth, Finance, and the Institutions, a very important department in the World Bank group. And after that, first we have a feature presentation by Dr. Kose, and after that we have also a feature speech on Chinese economic prospects. That is, we have Dr. Martin Reiser. He's the World Bank's country director for China and Mongolia, and also director for Korea. We have him to talk about that. And of course, while we are having this, we are actually joined by Dr. Ayhan she's the World Bank senior country economist, also join us today. And we have Dr. Patrick Alexander Kibi, is the World Bank senior economist as well, to join us today. So very distinguished expert from the World Bank. But last but not least, we also have Dr. Yao Yang. He's the Dean of China Center for Economic Research at Peking University. He will be joining us as well. And so we'll start with this our webinar, special webinar actually today. The first, I would like to introduce our featured presentation speaker, Dr. Ayhan Kose. He's the acting vice president of the EFI practice group and director of EFI prospect group of World Bank. And Dr. Kose has many years of experience at World Bank already. He managed operation policy and advisory engagements in the bank's global practice of finance and competitiveness and innovation, macroeconomics, trade and investment, governance, and poverty and equity. Has a very wide range of portfolios. He also leads the bank's policy and analytical work on the global macroeconomic outlook, financial flows, and the commodity markets. Under his management, the Prospect Group produced the bank corporate flagship report, Global Economic Prospects, in addition to other policy and analytical publications. So this morning, we're actually going to hear from Dr. Kose on this Global Economic Prospect report. And then Dr. Kose also has written extensively on international macroeconomics and finance. So many articles have been published in the leading academic journals and featured in prominent media outlets. And his latest book, Global Waves of Debt, just 2019, analyzed the likely consequences of the post-crisis debt accumulation in emerging and developing countries. So we are very fortunate to have Dr. Kose join us actually at such a already late time in Washington, D.C., to share his latest report to the great big audience here in China. So Dr. Kose, please, your presentation. Thank you.
Thank you, Dr. Wang, and good morning, everybody, our audience in China. It's great to be, joining you. Unfortunately, again, virtually. We are hoping that you will come and visit Beijing and do this event at the center sooner than later. And I'm very pleased to join you today with my colleagues, senior economist Eka. She is our senior East Asia Pacific economist, and Patrick Kirby, senior economist who works on global outlook, trade-related issues. And then, of course, I'm very happy that our China country director, Martin Reiser, is with us, and I greatly appreciate Dr. Yao Yang joining us to discuss our views today, and I look forward to the conversation with all of you. Let me quickly share the presentation we are going to deliver. Can you see the presentation? Everything is good?
Yes.
Okay,
yes.
excellent. We have these analytical pieces in addition to outlook pieces. But today for the discussion, I would like to focus on 4 questions. The first question is, what are the near-term growth prospects? And there, the basic message is that there is recovery. That's good news. We will see growth this year, but the recovery is going to be subdued, and this recovery is taking place against the backdrop of forecast downgrades in most emerging market developed economies and low-income countries, and the risks still tilted to the downside. The second question is, how has this pandemic increased debt-related risks? And these risks were there prior to the pandemic, and the answer is that we are already in the midst of the kind of the largest debt wave we have seen in modern history, and there was a significant increase in debt, and the low growth prospects complicate the risks associated with debt dynamics down the road. The third question is, how has the pandemic worsened growth prospect for the 2020s? And our assessment is that we have a more pronounced potential growth slowdown in this decade. We were expecting a growth slowdown in this decade, in potential as well as in actual, but now because of the pandemic, we think that the magnitude is magnified of that slowdown. And we might be getting into a period of persistent growth disappointment. So the policy is critical, how policymakers are going to respond. And the fourth question is that what are policy priorities? In the near term, of course, we need to address the health crisis there. It is essential to distribute aggressively and vaccinate the large segments of society as fast as possible. And then even the medium and the long-term reform priorities in a number of areas is going to be critical. Throughout the presentation, I'm going to use this acronym EMDs, and that stands for Emerging Market and Developing Economies. Let me start with the first question. What are the near-term growth prospects and how we see the global economy? Now, when we discuss the global economy in June, we were thinking that, yes, there was this very aggressive wave around March, April, and then hopefully we wouldn't have another wave in the winter time. Unfortunately, that prediction did not work out, in the sense that around the world over the past 3 months, we have seen a very aggressive spread of the pandemic and the new strain, even with the faster transmission and the challenges in advanced economies. There you see the kind of the developments in the US, in Europe, and of course, in the case of emerging market developed economies, on the right, you see in many regions still the confirmed daily new cases remain very high. And in some cases, of course, when you look at sub-Saharan Africa, when you look at South Asia, we still are grappling with the magnitude of the problem because of the limited testing capacity and consequences of that for our ability to gauge the true magnitude of the health crisis. So this background, the fact that there is another wave underway, had a huge impact on our growth outlook. As I said, there is growth this year, and that growth around 4%. But relative to our earlier forecast, we downgraded our growth number by about 0.2 percentage points. That's mostly because of advanced economies. We downgraded our US forecast, we downgraded our forecast for the Euro area, given the kind of the latest aggressive wave in both economies. And of course, in the case of emerging market developed economies, we have this growth number, 5%, and that 5% masks a number of different growth outcomes across regions and across countries. As much as we upgraded our growth forecast for emerging developing economies for 2021, in certain regions, for example, Europe, Central Asia, Middle East, North Africa, and then of course Sub-Saharan Africa, we downgraded our growth numbers. Just to remember what happened last year, if you look at our growth projection, the last year, this minus 4.3 is somewhat a better outcome than what we predicted in June, but still it is really a terrible outcome, the fourth deepest global recession we have seen over the past 150 years. This somewhat better outcome is mostly due to advanced economies performance, as well as the performance of East Asia Pacific at the back of China. So all in all, growth is back, but still by the end of this year, we are going to be lower than what we were expecting prior to the pandemic in terms of global output. And the fact that we won't be able to get back to the pre-crisis trend for the foreseeable future tells us we are basically going to experience a subdued recovery. Now, I mentioned this issue of this 5% number masking differences across countries and across regions. There, of course, when you look at East Asia Pacific this year, our growth number is 7.4%. This is a number this region used to deliver easily, but of course, the last year the growth number was around 0.9. But even that 0.9 was much better than what we saw in other regions. For example, in Latin America, Caribbean, in Middle East, North Africa, in South Asia. These regions experienced basically recessions they have experienced for a very long time. So a tragic year in terms of health outcomes and in terms of economic outcomes behind us. The new year is bringing growth, but still we are not out of the woods yet. Now, let me turn to these differences we see in the context of emerging market developing economies. So I mentioned this 5% number this year, and then in 2022, we think that that number is going to be around 4.2%. But if you take out China, the story is quite different in the sense that with China's growth, we are expecting 7.9% this year, and that really elevates the aggregate for emerging market developing economies. So if you take out China, growth projection for this year looks much more modest. For low-income countries, the real recovery is going to come in 2022. Now, how good these growth outcomes relative to the growth expectations we had 6 months ago? And the figure on the right tells you our answer to that question. As you can see, for the majority of countries, we downgraded our growth forecast for 2021. And for majority of countries, actually, growth outcomes for 2020 worse than what we expected. But in the aggregate, some big countries delivered stronger, basically, growth numbers and than what we expected, or milder recession. So the last year ended up basically with an upgrade. And this year, especially in advanced economies, for the majority of them, because of the second wave, we downgraded our forecast. And for emerging market developing economies as well, we became more pessimistic for 2021. And that shows basically with almost 75% of economies were subject to downgrades in 2021 as well as in 2020 relative to where we were in June. Now, one of the big points we are trying to make in the new report is the kind of the very serious collapse we see in investment. And there, if you look at the numbers, at least for advanced economies, the investment collapse looks somewhat milder than what we saw in 2009. And for emerging market developing economies, it's a totally different story. The investment is contracting about 5% this year for the whole emerging market developing economy group. But if you take out China, contraction is larger than 10%. So the having a kind of a 10% collapse in investment is just something, you know, we have not seen these economies experiencing any time in modern history. And of course, this collapse in investment is coming after a period of weak investment outcomes. And we are thinking that for the foreseeable future, at least till the end of 2022, emerging market developing economies, excluding China, will not go back to the investment levels they had prior to the pandemic. Including China, of course, the story is different. The China growth number in the case of investment as well is very strong. The story will be different. The fact that investment collapse and the foreseeable future gonna remain weak have significant consequences for this growth story for the medium term. We will discuss very soon. Now, this portrayal of the near-term outlook comes with significant downside risks. The first risk is the risk, actually, we are already experiencing, intensifying pandemic and the possibility of new waves in different parts of the world and the difficulty of containing the pandemic. The other issue is that the single most important policy priority is the vaccine deployment, and a delay of vaccine deployment or the resistance to get immunized in a substantial part of the population could create all types of challenges for the global economy to overcome the pandemic and basically become, in a sense, immune at the kind of the aggregate level. We are also worried about the possibility of financial stress. It is essential to avoid that, but debt levels are at record high. I'm going to discuss not just for sovereign, you know, the government debt, but as well as corporate debt. And there is forbearance measures in many countries, moratoriums for debt paybacks. And of course, sooner or later, these measures are going to be removed, and we might end up seeing a wave of corporate bankruptcies in many countries. There are some other challenges, of course, in some parts of the world. There are these serious problems associated with food security. And down the road, as I will discuss soon, we are worried about larger than expected decline in potential growth because of the, you know, the damage associated with the pandemic. And as much as we see the light at the end of the tunnel because of very effective vaccine available now, and we are hoping that the deployment is going to gain traction in many countries rapidly, there is the possibility of lasting change in household behavior that leads to, you know, consumption being away from services and tourism, and that there are certain changes in consumption patterns that will require adjustments in sectors and productions. And all of these could create all types of challenges. If people do not basically demand the types of services they are demanding at the levels we saw before, or tourism is not coming back, of course, these countries, they rely on services, they rely on tourist revenues, will continue to have difficulties. And we could then expect to trade and foreign investment flows, and the social consequences of the pandemic are important risks we need to monitor. Let me turn to the second question. How has this pandemic increased debt-related risks? Prior to the pandemic, global economy was experiencing a debt wave. Basically, we have not seen in modern history. Now, because of the pandemic, of course, the governments provided fiscal support measures, and these fiscal support measures required a significant increase in debt levels. These measures were necessary. But then what happened is that we saw a jump in government debt levels. In the case of advanced economies, we have not seen since the 1970s. In the case of emerging market developing economies, the jump was at the level we have not seen since the late 1980s, during, these economies had a series of debt crises. Of course, when you think about the magnitude of this debt wave and compare with previous debt waves, you see that it's just basically not comparable in terms of its magnitude, in terms of its pace, and in terms of how broad-based it is, how synchronized across economies. Now, this creates all types of challenges, given that we worried about the debt problems before the crisis, and these debt problems now magnified, especially in the context of low-income countries. Some of them are already in debt distress. Debt is now much higher, basically increased significantly from 2019 to 2020, above 70%. In fragile low-income countries, the number is even higher. But more important, the debt service capacity is lower. So if you think about, what happened, debt to government revenue ratio in these economies, the increase was like 100 percentage point in 1 year. Of course, driven by the collapse in output, combined with a significant increase in debt levels. So the debt to revenue ratio increased somewhere around 400% to 500%. And our projections suggest these economies are going to continue struggle going back to pre-pandemic trend level of output for the foreseeable future. That means their ability to pay back this debt is going to be, impeded. On the one hand, the amount of debt very high. On the other hand, you have this, limited revenue base, and of course, you are having difficulty to generate growth. So all in all, the big question for us here, this crisis started as a health crisis. Already, it is a very serious, real economic crisis, but there is a possibility it will turn into a very serious financial crisis. At least in the case of low-income countries, of course, we are worried. And the global community already responded with the debt suspension initiative. There is this now initiative by the G20, the common framework. Of course, the World Bank Group supports these initiatives, work with member countries to resolve the debt-related challenges. Now, what is interesting in this crisis, a number of emerging market developing economies did something they have never done before. They started buying assets to stabilize domestic financial markets. Asset purchases in these economies were much smaller than what we saw in advanced economies relative to their GDP. And at the first approximation, these asset purchases were successful in the sense that they were able to stabilize financial markets. Of course, this success came in an environment there was unprecedented accommodation and liquidity available in global financial markets, helping these economies to stabilize their domestic markets. Now, we are worried about these asset purchase programs in emerging market economies, primarily because the history of these economies financing basically their deficits through central bank asset purchases. Now, a number of these economies have better policy frameworks. A number of these economies are able to basically think through the consequences of these asset purchase programs. But at the same time, when we look at the kind of the universe of these policies, the fact that still the policies in terms of their scope, in terms of their duration, in terms of their objectives are not very well defined, and the fact that they are still in place while we no longer have the kind of the financial market volatility, all cause for concern as we are worried about the kind of the debt dynamics, the fact that there is this unconventional policies used by emerging market economies worries us. Now, let me turn to the third question. How has the pandemic changed growth prospects for the 2020s? Now, before the pandemic, when we thought about the potential growth over the period 2020s, we were expecting potential growth to be lower relative to what we had in 2010. This wasn't a kind of a surprising observation because advanced economies are going through a productivity slowdown. Emerging market developing economies going through a productivity slowdown. There is kind of a set of structural headwinds, especially in advanced economies, demographic transition leading to kind of a very smaller labor force that has consequences. Of course, this is a big challenge for a number of major emerging markets too. Now, on top of these things, as I mentioned, investment growth has been slowing prior to the pandemic and now collapse. Now, we think that in the post-pandemic period, we will see even lower potential growth in the 2020s. And this will be the case basically across the board in all regions, including East Asia Pacific. We will see a weaker potential growth in 2020s, and that has consequences in terms of creating jobs, that has consequences in terms of creating, wealth. Now, one important observation is that how these developments are going to affect long-term growth expectations. These expectations were weakening before the pandemic. So in 2010, for example, we thought emerging market developing economies are going to grow around 6% in 2020. Now, when we look at 2020 10-year head growth forecast, that number went below 4%. So the growth expectations for the next decade declined by about 2 percentage points over the past decade. For advanced economies, something similar happened. In 2010, we were thinking that these economies would still grow around 2% over the next decade. Now, that number declined to 1.5%. Now, what happened is that I think after the global financial crisis, there was this understanding that, yes, potential growth slowed, but it took time to internalize that understanding. We had this period of serial growth forecast downgrades, 2010, 11, 12, 13, 14, that continued. Now, when you have these types of deep recessions that have consequences for long-term growth expectations as well as potential growth, and anywhere you look at it, depending on the recession, that impact is between 0.8% to 2.2 percentage points after 5 years, a decline in long-term growth expectations. Of course, when the long-term growth expectations decline, that has consequences for investment growth as well. Let me turn to the final question. What are policy priorities against this backdrop I discussed? And there, the single most important priority, the supporting the healthcare systems, accelerating vaccine deployment through global coordination. And we already see the challenges in that within nations and across nations. It's going to be the single most critical job for policymakers, really find ways to mobilize the forces to vaccinate large chunks of populations as soon as possible and get immunity at a level manageable to go back to some type of normality. Still, protecting the poor and vulnerable is a priority. As I mentioned, growth is coming back, but it's still going to be weak. In that context, the need to strengthen safety nets and, of course, given the the debt challenges, providing coordinated debt relief to low-income developing countries is going to be critical for the global community. The policies for the near term, really keeping the economy afloat, still critical. That means assisting viable firms, improving insolvency frameworks for speedy bankruptcy resolutions, and supporting the demand. As you see, still large fiscal support programs countries are implementing around the world, and making sure financial stability is preserved. The broader challenge down the road in an environment the fiscal space is very weak is institutional reforms. And there, the reforms have the the usual scale and scope, but some more important than others. I think we learned that enhancing digital infrastructure critical, investing climate resilience going to be even more important in an environment. There needs to be significant infrastructure investment. Educational losses were critical during the pandemic. That had implications, of course, for potential growth narrative I mentioned, and finding way to improve education to cope with those losses. And of course, coordinating policies globally to address these global challenges, including climate change, trade-related disputes, and finance-related issues, going to be all critical. Now, is it possible to reverse this slowdown and basically keep the potential growth at a certain level? Our answer is yes. That will require basically very serious, comprehensive reform measures in terms of improving investment, in terms of bringing more women to labor force, and in terms of improving institutions to basically deliver higher productivity growth. If those are types of policies aggressively implemented, we think that potential growth could basically be kept at levels comparable with what we had in 2010s, rather than having a significant decline. One important message of the report is that when countries implement aggressive reform programs, financial market participants reward them by increasing long-term growth expectations. Good policies have basically better growth expectations associated with them, and bad policies have worse growth expectations associated with them. The bottom line is that this is high time for policymakers to really implement the types of policies to improve the long-term growth prospects Of course, this differs from country to country, what policy is necessary, what are the big priorities. But there is no question, given the limited fiscal space we see in many countries, the institutional reforms with respect to kind of the business climates, reforms with respect to governance, gonna be critical down the road. So let me summarize. The first question I asked, what are near-term growth prospects? As I said, the growth is back, but recovery is going to be subdued and risks still tilted to the downside. The second question, how has the pandemic increased debt-related risks? The answer is that we were already going through the largest debt wave we have seen since 1970. Pandemic, in a sense, put gas into this fire, and we basically saw a jump in debt levels at historical levels. Now the debt at the global level close to 100%, which is basically a record, and debt-related risk much more magnified today. Of course, there's a significant accommodation in the system. Interest rates are low. These solvency problems are basically being masked with these types of accommodation measures. But let's don't forget that low interest rates are not a panacea when it comes to emerging market economies. They are subject to changes in investor sentiment, and high debt levels are kind of the main vulnerability for them. The third question was, how has the pandemic worsened growth prospects for the 2020s? We had kind of a weaker growth expectations in 2020s. Now those growth expectations even weaker because of the decline in investment growth, because of the human capital losses, of course, because of the impact of the pandemic on productivity. And we are worried about, we will basically have a decade of growth disappointments ahead of us unless policymakers act in an aggressive way. And finally, what are these policy priorities? Everything starts with very aggressive vaccine deployment and then containing the pandemic. And after that, basically countries taking care of their houses in terms of policies, but at the same time cooperating globally, addressing global challenges. So let me again thank you for this invitation. I look forward to the conversation and answer the questions. Thank you.
Great. Thank you, Dr. Kose, for your excellent presentation. I think this is really highly relevant and also was all our attention. You know, you have raised the four big questions, and of course, the key growth prospect for the world, and also how COVID-19 going to increase the debt-related risk, which is, I think, many countries should really pay attention to that. And also, what about our growth prospect in the 2020s? I mean, that's we're getting into new decades. I mean, we have to really be aware of that. And of course, you gave a very good policy priority recommendations, which I think are really highly relevant for all countries, probably to adapt to their own situation. You know, save lives and you know, threatened by pandemic probably is the top priority, and protect the poor, the vulnerable. That's really the key, I think, as well, and maintain the you know, foundation and of the economy fundamentals, and of course the strengthening the policy and digital education, you know, all the structure going on. So thank you so much for your great sharing of this very enlightening but also highly relevant for many countries in the world, including China, of your new latest report. Now I'd like to also introduce our next speaker is Dr. Martin Rieser. He's the World Bank country director for China and also Mongolia, and he's also director for Korea. He has taken care of quite a few countries. He's been in China for some time. I we see Dr. Martin from time to time here in Beijing, but he was the country director, of course, for this for quite a while, and but he's leading a team that is managing one of the World Bank's largest loan portfolios and directs an extensive analytical and advisory program with China and Mongolia, and also a growing knowledge in partnership with Korea. One of the things impressed me the most is the Dr. Martin. Also, he's very fluent in multiple languages, including German, English, French, Portuguese, Russian, and Spanish. So that's really amazing. And he also published numerously articles in economic journals and in the monographs, several monographs as well. He has a very well academic background. He's a doctorate degree in economics from the University of Kiel in Germany, and also a degree from economic history from London School of Economics and Political Science. So he has worked in many institutions, including of course the European Bank for Reconstruction and Development. He was also country director there then, and also editor of the Transition Report. So Dr. Rainer, you are in China. You know China, and also you're also been in World Bank since 2003. So what's your take of what just Dr. Kose just said, but also your presentation on your view combining China and the world? Dr. Martin Reiser, please.
Thank you, Dr. Wang, for that very kind introduction. Unfortunately, I don't speak Dr. Kose's language, even though I spent a few years in Turkey, but it's far too difficult, and I'm afraid Chinese may also be too difficult for me. Ayhan asked 4 questions. I'm just going to ask one question, and that question is, how is China different? And I think it's clear that China's performance, when you look at the data that Ayhan presented, is very different than that of other emerging markets, and indeed is quite different from the rest of the world. If the rest of the world is experiencing, if anything, something like a tick mark or an L-shaped recovery, in the case of China, it's really been very close to a V. So in that sense, it's really quite different. It's also different with respect to investment. Dr. Kose pointed out how the world is seeing investment plunge, and that has potential implications of long-term growth. Whereas in China, investment rates have always been, extraordinarily high, and they haven't really fallen significantly over the full year of 2020. They fell in the first half, and then they recovered very quickly. Dr. Kose also pointed out concerns of a trade, but one of the things that has surprised us is how robust and resilient China's trade performance has been, particularly on the export side. And that's because China had the ability to start up its factories earlier than elsewhere, and it happened to be able to re-engineer its export profile to deliver the kinds of goods that the world was demanding, medical equipment and consumer electronics. And so Chinese export performance, despite of a fairly gloomy global outlook over 2020, has done actually rather well. So in that sense, China is different. Now, in some sense, China is the same. China is the same with respect to debt. China has had a massive increase in debt domestically, and China is a source of financing for some of the increase in debt that we've seen in other parts of the world. China is also very similar with respect to the productivity slowdown that Ayhan described. Productivity declined before the onset of COVID everywhere, but nowhere did it decline faster than in China. And in our innovative China report that came out about 2 years ago, we pointed to the fact that China's growth model that had generated very fast economic growth over several decades was running out of steam, and there was no prospect for the same model generating the similar kind of growth rates. And so you do see also in China a decline in potential growth estimates into the medium term, and the need for reforms to rekindle productivity growth and put growth on a different foundation. Now, how does this picture in China connect with what's going on in the rest of the world? I think there are important connections that have implications for the global outlook because of China's importance in the global economy, but also have implications for policy. The first is that the pattern of China's economic recovery, even though it has done much better than most countries in the world during 2020, has been imbalanced. It's been imbalanced in favor of external versus domestic demand, and you see the emergence of a Chinese current account surplus again after it had virtually disappeared in 2018 and 2019. And that's obviously creating significant strains in the global economy in a context where the rest of the world isn't actually growing. So the current account surplus is not due to other countries growing very fast and sucking in Chinese demand. It's due to China's strong competitiveness, but also to the lagging pattern of China's internal demand versus external demand. Secondly, it's been imbalanced because consumption has recovered less quickly than investment. And so an economy that invests a lot, that increases its supply capacity, but that doesn't generate the domestic demand to absorb that capacity, in a world in which global demand is unlikely to be there, is going to face sustainability concerns over its ability to continue this level of performance. And so clearly the discussion in China in the context of the 14th five-year plan is now around strengthening domestic consumption as a driver of economic growth. And I think that has huge implications for China. I think it's a good thing, but it also has significant implications for the rest of the world, because to the extent that China manages to become an engine for global demand on the consumption side, I think this is good news for Chinese consumers. This is good news for China's trading partners. The second implication is that an investment-driven growth model is very closely associated with a very rapid buildup of debt in China, and a model that generates current account surpluses is closely associated with a rapid accumulation of foreign assets by Chinese banks, and hence is the flip side of the very rapid increase in debt that we've seen in many emerging markets. And so China's ability to shift to a more domestic demand-driven growth model is important in terms of contributing to reducing the global savings glut that is likely to continue in an environment in which global investment demand remains depressed and the global economy is growing less rapidly. So it's really important for China to achieve this rebalancing. In terms of China's internal debt issues, it is clear that 2020 marked a return to a pattern in which economic growth was driven by further accumulation of debt. And that's almost inevitable in the circumstances. But it's also clear that that pattern cannot continue indefinitely, in the sense that already today, the debt to GDP ratio in China is highly elevated. And for every percentage point of increase in economic growth, China currently generates 3 percentage points of GDP increase in the debt to GDP ratio. And so unless China finds a way to grow without the reliance on debt, its debt is going to continue to increase very rapidly as a share of GDP. So the importance of what in China you call the de-risking campaign cannot be overemphasized. And the difficulty of doing that in an environment in which you come out of a period of regulatory forbearance, where regulators have closed at least one eye and maybe an eye and a half over the accumulation of potentially non-performing assets. So the need to do that de-risking at the same time as you prevent the zombification of enterprises that have elevated debt levels without causing instability in the financial sector, I think is going to be a key challenge. So I don't want to speak much longer than that, but I do think that China's performance is different from that of the rest of the world. This is a good thing for China, and it's been a positive thing for China's trading partners. But China's impact on the global economy could be even more positive if it manages to rebalance the source of its economic growth further towards consumption and towards productivity growth, and relies less on investment-driven and debt-fueled economic growth as it has done in the past. And that requires a number of reforms which we have outlined in our December China economic update, which is very closely linked, of course, to the forecasts that Ayhan presented today. The reforms that we have advocated are not new. We have said several of these things before, but we have pointed to the need for China to introduce structural measures that may reduce domestic savings rates, one of the ways in which that can be done, and encourage consumption. One of the ways in which that can be done is to build a stronger social security system to reduce the need for precautionary savings. A second way in which this could be done is to further liberalize labor markets and allow people to move towards, to move their households towards places in which productivity is likely to be higher. That would be generate and liberalize the ecosystem. That would generate a significant wealth transfer to the households that would benefit from that. That could also increase consumption and reduce the need for precautionary savings. And perhaps equally importantly, adopt structural reforms by strengthening the quality of the allocation of capital that would generate more productivity growth. And there, I think, to end on a positive note, one of the things that has clearly been demonstrated during the past year in China is the importance of digitalization as a new form of doing business. The pandemic has accelerated this trend, but China has shown itself to be particularly well placed. And so, e-commerce, fintech, and other similar industries have really provided quite a boost to the Chinese economy and provided some continuation to consumption in the course of the pandemic. And so those are trends that could potentially point in the direction of faster productivity going forward. But we've also seen during the crisis significant investment going into old industries. And it's not so obvious that those investments, further infrastructure in the interior, further development of old energy sector, are necessarily going to either generate productivity growth or indeed prepare China well for a future of climate change. And so there's a need, I think, in the allocation of capital to think more about what are the future areas of potential growth, and to do that based more on market principles and allow the private sector to play a larger role in the allocation of capital. So with those remarks, let me stop here, and I really look forward to hear from Dr. Ayhan, who knows so much more about the Chinese economy than I do, and hopefully can complement my picture, or perhaps.
Great, thank you, Martin, for your excellent, discussions on Chinese economy, and also the analysis of the situation of all the challenges, opportunities that we're currently facing. I mean, I remember last time when we had this event in June last year. World Bank forecast China last year growth was 1%, something like that, but now it's 2%. So it's actually, we see some positive side from China's economy. Of course, also we hear that Dr. Kose mentioned about digital economy. I think that played a huge role in Chinese pandemic fighting as well, including all the infrastructure facilities that has been connecting China logistically. And for example, China's the transcontinental train to Europe have actually increased during the pandemic, and then the year before. So we see many things actually happen here in China. So talk about China. I'd like to bring my friend, also a renowned economist in China. He's the dean of China Center for Economic Research at the Peking University. Last time when I saw Dr. Ayhan was at Paris Peace Forum last November. I think it was hard time flying, but actually Dr. Yao is a Changjiang scholar and a liberal arts chair professor at the China Center of Economic Research, which is very well known think tank here in Beijing. And also he's at the National School of Development at Peking University as well. And he currently serves as director of CCER and also the dean of NSD, executive dean of ICCCAD, has many dean's titles, and he actually the editor of CCER's House Journal China Economic Quarterly. He's also a member of China 50 Economies 50 Forum. So his interest is more focused on the economic transition and the development in China, and published in many research papers in different international domestic journals. So Dr. Yang, I know you've been really active in many of those areas. So why don't you share your perspective in relation to World Bank report this morning, but also your impression of Chinese economy during the pandemic in general, and what's to be done in the new year and beyond. Dr. Yang, please.
Okay, thank you, Huiyao, I'm sorry, for inviting me here. And I also appreciate the presentations of Dr. Kose and also Dr. Riza for their forecast on the world economy and also opinions on the Chinese economy. Let me then continue on the discussion to talk a little bit on the Chinese economy and also make some comments on the forecast and opinions expressed by the previous two speakers. So first on China's recovery, we all know that China's recovery is not symmetric. Most of the recovery came from the supply side. Then the demand side, particular consumption, has lagged behind. As a matter of fact, China's recovery has been strangely helped by the spending in rest of the world, particularly in advanced economies, right? So there's kind of a mirror symmetric recovery in China and advanced economies, right? While consumption in the United States, in Europe, and also in Japan has kept the pace of growth. China's consumption lagged behind, but then China's supply has recovered much faster than the rest of the world. So export again became one of the strongest drivers for China's economic growth. In the first decade of the century, export growth contributed about 1/3 of China's total growth. Last year, it was about 1/3 again. So that's kind of going back to the past. But of course, I don't think this is going to be sustainable, and I don't think this is going to last for long. Probably entering the second half of this year, we are going to see slowdown of China's export. But having said that, if we look at the newer data, we are going to find the employment has picked up in China. According to a survey done by my colleague, Dan Zhang, she found the unemployment rate in the very beginning of the pandemic was about 10%. This was different from the MBS data. That was just because MBS only looked at urban employment. But the Dandan's survey covered both urban and rural China. But her latest survey shows that unemployment rate dropped to 4.2%. I think that's the number, or 4.5% by November. So that was a substantial decline of unemployment rate in China. Together with that, we see income had picked up by the end of last year, and the consumption became positive on a year-on-year growth. Okay, so those are the good signs, right? But we also see that as an impact on China. So looking into this year, I think the pandemic is still a major risk for the world and also for China. Of course, China has implemented a quite tight control on the spread of the virus from Shijiazhuang. Recently had more cases of infections, and the government then acted quite swiftly. Right? But of course, that has a negative impact on the economy, not just on the city, but also on cities around it, including Beijing. Right. So the spread of the virus is still a risk. It totally depends on the speed of the vaccine, right? When and how many people are going to be vaccinated, right? So that's the major risk. But if we can contain the spread of the virus like China did in last year, then I believe this year China's economic growth is going to reach 7%, 8%. And then in a little longer term, I can see a new booming cycle is coming, right? So, starting from 2010, China's economy entered a period of adjustments, right? And by the time of 2016, China's economy entered a new period of the booming cycle, but that cycle was cut off by deleveraging and also the pandemic. Right? So if everything goes well, then this year is going to pick up the booming cycle, and then this booming cycle is going to last for 5 to 7 years. Right? So if we look at China's 14th five-year plan, we see the government is increasing efforts to boost the economy or to bring a new waves of growth to the economy, although the government has not set a growth target for the country. But if we look at the general goal, that is by 2035, China is going to double its per capita income. So you do the calculation, you figure out China has to maintain an average yearly growth rate of 4.8% to reach that goal, right? So growth is still important, right? Here I would like to highlight several major, major drivers for China's future growth. One is technological advancement. The U.S. Strategy to contain China's technological progress, I think is doing just the reverse. That just gives China more incentive to accelerate its autonomous technological innovation. And that's going to become a strong driver for China's growth. Another one is urbanization. This is the second wave of urbanization. It's not just a labor movement from the countryside to city, but also labor movement between cities. Those big cities, as the governments designated so-called urban center. Nine cities have been designated as urban centers, and then population will move into those centers, and we are going to see huge urbanized regions in China in the next 15 years. So probably 60 to 70% of China's population will live in those urban centers. Okay, so that's a sea change of government policy toward urbanization. and that's going to have an implication for China's growth. A third driver is more equalization of public service delivery. This not just means equalization between urban and rural areas, but also between regions. That's going to dramatically increase infrastructure investment in some less advanced regions, and also in the countryside, right? And this also means reform of China's social security system, including the Huiyao registration system. Okay. And last but not least, China has launched by 2030, China is going to peak carbon emission. Okay. And then by 2060, China is going to reach net zero. Those two commitments are real and are going to be enforced. The government is gearing up efforts to reach those two goals, particularly the emission peak, right? Because it's so near, only 10 years. So the government has begun to launch measures to reach that goal. I believe the People's Congress meeting in March is going to spend much effort on those two topics. Okay. Of course, that's going to increase the cost of ordinary companies, but they're also going to create a new industry that is this emission reduction industry. Right? So ultimately, it's going to be good for China's economic growth. Of course, that's going to be good for the whole world to combat climate change. Right. Last, let me comment on China's debt issue. Yes, the debts are quite a concern in China, particularly local government debts. If you look at last year, local government's commercial debts, I'm not talking about the government debts, right? Because that's monitored. If we only look at the so-called municipal bonds market, local governments issued about 3 trillion municipal bonds, right? So think about this, by the end of 2019, the total stock of municipal bonds was about 60 trillion, right? So last year we increased 50%. So that was just so dramatic, right? I mean, the only hope is that continuous growth is going to dilute those debts. Then another way to digest the debts is to do debt swap again, right? So government issue long-term debts to swap the short-term commercial debts. And probably we can also see some rating off within the state sector. That's kind of a strange advantage of the Chinese economy, right? Because, on the one hand, those are local government debts. And then on the other hand, the creditors are mostly government-owned financial institutions. So if the government is willing to do that, it can just write off those debts within the state sector, right? Of course, that's going to have some negative implications for the whole economy, but the shock is going to be much smaller than a pure market economy. Okay, so let me stop here. Thank you.
Okay. Thank you, Dr. Yao. And so I think that we have actually a China case with World Bank looking at the world, but also at China as well. So far, actually, our webinar has attracted over 800,000 to 1 million viewers online. for Wednesday busy morning here in China, but great. We also received quite a number of questions, and of course we also have Dr. Vashmadzi and also Dr. Kirby online as well. I want also you public comment as well, of course, with all our panelists. We have collected quite a few questions from the different medias here, actually here based in China. For example, one of the questions from China Business Network ask if interest rates rise in the future, the government's high debt will be unsustainable. How do you think the risk of high debt should be diffused? So that's one question. Another from the same media said China's exports are very strong in 2020. Do you expect this level can be sustained in 2021? Also from CCTV, China Central Television News, how will China's development, especially in economy, help to promote the world economy recover together? And also there's another question from Market News Information, which is international outlet. So what do you think about GDP target this year? Of course, Chinese government actually didn't now, as Dr. Yao just said, not mention it anymore, but the World Bank actually predicted about 7.9%. So because government also wants to step up the management on the demand side. So what does that have impact on the economy? And there's another question from the papers from China. The last report of the World Bank in June 2020 predicted that China would be the only country, major economy with a positive growth of 1% of 2020. Recently, institutions, of course, World Bank and IMF and others, predict China economy will rebound rapidly in 2021 with a growth rate around 8%. So, but in the context of flood of the global liquidity, what do you think about China's deficit rate and monetary policy this year? And what impact and effect will this have on the global economy? So those are some general questions. We have about 10 minutes left, but I think I would like to go to probably we have two senior economists here from World Bank, from Dr. Kose's group. So for this morning, but also for World Bank report, including final some questions. What do you have anything to comment or add? Perhaps we start with Dr. Akintana Vashmadzi, excuse my pronunciation. Do you have any comments, May?
Yeah, so thank you very much again for inviting me to this session. It's very interesting. I think perhaps in response to the questions, if I take some view, most of those were partly, I think, addressed in the presentations. I think especially on the lower interest rates in future, clearly this is something which is our assumption in baseline. But in the situation that we have now, there can be sharp increase, clearly, right? An unexpected abrupt tightening. And in that context, of course, the high leverage creates big vulnerability and risk. Now, at the same time, given the fragility of global recovery and even recovery in China, as Ayhan, Kose and Dr. Martin Reiser had said, fragility related to private sector is still very much weak, and growth mostly driven by stimulus. Very sharp withdrawal of stimulus clearly is not warranted. So despite the effect of these high vulnerabilities and high debt, both the Global Economic Prospects Report and China Economic Update said that for major economies, which still have policy space, they should really watch the global developments and be careful in withdrawing stimulus. I think perhaps I will stop here and then let Patrick to respond to other questions, especially the ones related to sustainability of trade and export Chinese. Thank you.
Yes, Dr. Kobe, please.
Thank you for having me. This is a great event and I'm happy to be part of it. Yes, so on global trade, we saw a fall in trade in last year that was comparable, a bit less in fact, than what we saw in 2009, despite the fact that the economic damage was much more severe. So this recession has been relatively less damaging on trade. And the reason for that is this recession is a very services heavy recession. People are afraid of getting infected, so they stay away from services, predominantly services, and they don't stay away to the same extent from goods, because you don't need face-to-face contact to consume goods. So there's still been a great deal of damage to all sectors, but relatively speaking, there's been less damage to goods, and goods are much more heavily traded. So as the East Asian export-led economies know, goods have a very high trade content. There was also some concern early during the recession that global value chains would be a source of weakness. People thought about earthquakes in Japan in 2011, I think, that really propagated damage from one economy to others. And in fact, GVCs have been quite resilient, and we've seen quite a bit of the fact that the shock has been so broadly distributed. It means that many domestic industries have been damaged just as badly as these internationally connected ones. And in fact, GVCs may have even been a source of some resilience because they have a bit more size, a bit more access to financing. They tend to be larger companies, or at least there tend to be larger companies in these GVCs that provide the backbone that remained healthy. So that being said, the health in GVCs has been they've been able to meet demand at a time of very low demand. And so as demand increases, we may start to see some supply constraints moving forward. So we actually expect that the recovery in trade will be fairly weak. GVCs may encounter some supply constraints, as I said, as demand returns. We've already seen that a little bit in the superconductor industry. We're seeing some rumblings that there may be supply problems there. And we also expect, as economies recover and the virus is slowly successfully defeated, we'll see a rotation in demand away from goods and back towards services. And so that will slow the recovery in trade, since trade is so goods intensive. So, so we've seen some fairly impressive growth in trade, but we expect things to slow down moving forward.
Yeah, I think just to add specifically to the question which was asked, which was if China's exports will continue to be solid and solid growth, I think there is one caveat. So clearly, as global demand recovers, we will see sustained or stronger demand somehow, with caveats that Patrick has alluded to. But at the same time, as global production recovers, clearly, as Martin said, China was the only country which was able to supply when the global production otherwise was stalled, and that will be corrected. So there will be other countries which will join this global production, and then we are seeing a little bit of normalization in the baseline of China's trade. At the same time, Chinese imports, we are expecting, will strengthen again in the baseline scenario, and all these imbalances in the baseline scenario, we think eventually will be corrected if Chinese policies will stimulate more domestic demand and we see normalization. Now, clearly, this is our baseline scenario, but there are lots of risks, and especially downside risks, which Ayhan has discussed already. Thank you.
Okay, thank you for both experts. Great comments. Maybe final word from Dr. Kose, Martin, and Dr. Yang, maybe briefly. Dr. Kose, please.
Yeah, thank you again for this invitation. The kind of this question about how important China for the rest of the world and how large these spillovers something we spend quite a bit of time on. It depends then what you are looking at, but China growth increases by 1 percentage point over a 3-year period. You see that give and take between 0.5, 0.7 percentage points increase in growth in other emerging and frontier market economies. So China plays a very a significant role, not just basically mechanically increasing global growth, given its size and fast growth rate, but it generates significant spillovers to other economies. Of course, China is the #1 customer of a wide range of commodities, playing a very significant role in commodity markets and positive spillovers to those commodity exporters. But the bottom line is that we, of course, upgraded our China forecast by 1 percentage point this year. And of course, last year, the growth surprised on the upside by 1 percentage point. The reforms Martin mentioned are going to be critical in the medium term to sustain China's growth and transition to a kind of a lower growth rate, but the more sustainable, more durable growth down the road. With that, let me thank you again. It is a privilege to have this event and join with colleagues, of course, our country director in China, Dr. Reiser, and Dr. Huiyao Yang. It has been an excellent discussion, very informative for all of us. Thank you again.
Thank you. So, Dr. Martin Reiser, your final word, comments.
Thank you, Dr. Wang, and let me just also say thanks for this great opportunity. I just wanted to say one brief final remark, which is to emphasize something that Yao Yang said on the potential of China's accelerated greening for economic growth, for global climate change, and this in an environment in which China is one of the countries that has some policy space and that potentially could benefit from the very, favorable global liquidity conditions, but only under the condition that it sets the right framework for allocating capital more efficiently. Currently, China allocates more resources to the kinds of industries that are likely to be obsolete if China wants to reach the climate targets, and not sufficient money is going into the new industries. If that rotation happens, that's going to be good for growth, that's going to be good for the climate. And so I really hope that Yao Yang is right when he thinks that this is going to be a key theme of the upcoming 2 sessions. And with that, I'll give him the final word.
Okay, Dr. Yang, please.
Yeah, let me pick up the question about the connection with China and the rest of the world. Dr. Kose has touched upon that. Let me just add China's relations, in particular with Southeast Asian countries or ASEAN countries. Right? Inside China, many people are worried that when export is being diverted to those countries, that's going to hurt China. But the reality is that diversion of export is helping the region and also helping China in 2 ways. First, increase China's export to those countries. And second, that increase China's domestic demand, right? Because China now is getting imports of consumer goods from those countries. That also contribute to the world economy. I just did a rough calculation. Probably this year, China's growth is still going to be 1/3 of the total world growth, right? So if China grows fast, then the whole world is going to benefit. So if my prediction of a new booming cycle in China is correct, then probably it's safe also to say that the world economy is going to have a relatively booming period in the next 5 to 7 years.
Okay, great. So now we come to the conclusion of this excellent webinar that organized by Center for China and Globalization and also World Bank Group. We really appreciate Dr. Kose for giving us a very good presentation about global economic prospect report, which has the bank has made a prediction for the world economy outlook for the 2021, And so given the global economy contraction of 4.3% in 2020, the global economy is expected to grow by 4% in 2021. And China's GDP growth is expected to reach 7.9%. And the developed economy like the United States, Europe, and Japan will reach GDP growth rate of 3.5%, 3.6%, and 2.5% respectively. So I think this is really a great landmark that we're going to see in the year ahead. So I think that great, as we all see, also for China. China is really still keep economy grow pretty strong, even with pandemic and with the dual circulations that his government is proposing. We see that it's 400 million consumer strong economy emphasized, and also of course with the global value chain, with the global pandemic, the global value chain position seems to be central position still to be seems to be very much strengthened. So I think that we hope that China will continue to play a positive contribution to the world economy, and also to continue work with international community to fight COVID-19 with the vaccine. Hopefully we could have some vaccine summit between China, US, and EU, and we hope that we can get this under control. So once again, I'd like to thank our panelists today, Dr. Ayhan Kose, Acting Vice President of EFI Practice Group and the Director of EFI Prospect Group, World Bank, but also the Martin Reiser, World Bank Country Director for China and Mongolia, and also Korea. And also, of course, we have Dr. Yao Yang, the Dean of the China Center for Economic Research, Peking University. And also we have Dr. Vashin Matizi. Actually, she's the Senior Country Economist, and also Dr. Patrick Kirby, World Bank Senior Economist. And also, of course, with almost 1 million viewers again, on this Wednesday morning from both China and internationally. I want to thank all our viewers very much for viewing our presentation today. So thank you all very much. Until next time, thank you so much.